So I'm sorry, given your answer for Reuters, given your comments today, I mean, are we in a history situation in the U.S. now?
You know, my discussion of Sweden was meant to be a possibility, and only that. And it's illustrative, I think, that the reversal of the changes in U.S. labor market performance that we've seen over the past few years, a reversal is not definitive and deterministic. At the same time, I don't think the Swedish experience is either. It's just these are. I wanted to be clear, I think, about the range of uncertainties that confront us as monetary policymakers about what does maximum employment mean for us today.
And I'm sorry, and your feeling about it is, I think you said that we're much closer to. Well, if you could explain, where are we right now at 8.1% unemployment in terms of?
So there's two parts to that question, Ann. So one is where we are now and where we're going to be going in the future. I think that maximum employment is something that evolves over time. It's not just where we're going to be in the long run. So I think we will continue to see. I think right now we're closer to maximum employment than the 8.1% number would suggest. But I think over time we will see unemployment come down. My outlook, as you can see by looking at the consensus, I'm in that consensus from the FOMC of maybe towards the upper end. So if I think about long-run unemployment under appropriate policy, I'm thinking about 6%. I think the challenges are really about labor force participation, employment population, what those are going to do over time. I feel a lot more uncertain about that.
What, if anything, should policymakers here in the region and nationally do about this mismatch between the jobless and the jobs that are available?
Well, it's a good question. I mean, I confront it more as a monetary policymaker, I have to say, and for me it represents more a constraint as opposed to a challenge for me. I mean, it represents a limitation of what we can do as opposed to something that we can address. So I hesitate to give advice to other policymakers. I don't necessarily appreciate when they give it to me, so I'll refrain from saying more than that on that question.
I just want to make sure I'm reading between the lines here properly. So when you're pointing out that the framework statement said that maximum employment is largely determined by non-monetary factors, and yet the committee is really committed to trying to achieve that. Are you seeing like a futility in that goal of trying to get to maximum employment when there are all these other factors as well?
So the term maximum employment refers to what is maximal. The way I think about it, and I think the way the statement thinks about it, is that it's what's maximal given what we can do with monetary policy. And as I was indicating in my answer to Ann, I think that right now we are, given the behavior of inflation, that signals to me that we are probably closer to maximum employment from the point of view of what monetary policy can achieve than what that just looking at that 8.1% number and comparing it to historical norms would indicate to you. So when you think about maximum employment, it's really about what are the constraints on what monetary policy can achieve, both right now and then over the course of the longer haul as well.
Aki from Bloomberg. Europe's debt crisis took a new turn this week with Greece's elections, and I just wanted to get a sense on how you're monitoring the current situation right now, your assessment of the crisis over there.
Yeah, so my assessment has been that I think that it's been over a relatively long period of time. I've been thinking that this is going to be a situation that is going to proceed along. It's got a lot of challenges built in there for European policymakers. I personally have been struck by how well they've been doing in the face of those challenges. I didn't see any change in my broader perspective on the situation from the events of last week. Just to add a little bit of color on that, I think the FOMC statement highlights that there are risks associated with that situation, but I don't think that those risks have changed materially for me and my outlook over the past week.
Just so I'm clear, Jennifer from the Star Tribune, just so I'm completely clear, you think the U.S. labor force changes are more protracted, right?
I did not say that. I said that it's a possibility that they could be more protracted than we have been used to seeing in the post-war period. So in the post-war period, the deterioration in labor performance that we saw during recessions reversed itself in relatively short periods of time after the recession itself. What I was pointing to is the fact that when you look at other countries, you have not, Sweden in particular, after their triple crisis, we had not seen that same kind of reversal. So when you're thinking, there's no definitive answer to these questions. There's a range of possibilities, and you have to confront that range of possibilities as a policymaker, and I think be open and honest about the fact. My theme of my speech was really about transparency, and I'm trying to be transparent about the uncertainties that I face as a policymaker.
I know you like to stick to the mandates, but I just have to ask a broader question. Your counterpart in Dallas has been very outspoken about the need to break up the big banks. And I'd love to find out what you think about that. If that's something you spend much time thinking about.
I mean, I think that it's a very that certainly our bank, our institution, my predecessor Gary Stern and Ron Feldman literally wrote the book on Too Big to Fail back in 2004. They talked about some of the challenges. For myself, I think the term too big to fail is probably overly simplistic. It's really about too systemic to fail, too interconnected to fail. And at times I think the focus on size is perhaps leading us astray. Obviously bigness is a component in being systemic. Okay, so they're not isolated from one another. But I think it's important to have this more nuanced view of both being systemic. And I think the Dodd-Frank Act has that broader perspective appropriately. So bigness is associated with systemic, but it's not the only factor. And I think so the steps that are in Dodd-Frank, I think, have moved us in a good direction in terms of some of the challenges that come up when we think about what is like lumped into the too big to fail category.
Hi, Mark Peters.
Hi.
How you doing today? I was just wondering your thoughts on when, with the quantitative easing program that's ending in June, what your thought is about whether that will have any immediate or midterm effect on the U.S. economy.
Yeah, I mean, I'm a stock person, not a flow person. So what I mean by that is that I don't think the ending of the program per se will have much of an impact. I mean, it's people have pretty much taken into account in their expectations of how much the Fed is going to do in terms of Operation Twist, the maturity extension program that was adopted in September. That'll unfold in June. So I think that's already baked into the cake in terms of performance. So I don't. Yeah, I guess the short answer is I don't think the ending of the program per se will have much of an impact. I could go further and say de minimis impact.
If I could ask another question, you said earlier this week, I think you said that you might need to be thinking about starting to think about an exit. I think might have been how you said it, as soon as 6 to 9 months. What kind of form, what shape would that thinking about starting to exit? What do you mean by that?
I think. I continue to watch inflation very carefully, and not just in terms of because I'm concerned about price stability. It's more because it's a guide to, I think, how close we are to maximum employment as well. So it's informative about both sides of the mandate for me. And so if we continue to see inflation ticking upwards and being rising relative to where it is today, I think that's and that's something in my baseline outlook, I've talked about seeing inflation of around 2% in 2012 and rising to 2.3 in 2013. I think those kinds of numbers would lead one to think about initiating the exit strategy. And by initiating exit, I think it's we've sketched a relatively long and lengthy exit strategy that the FOMC sketched what that would look like in June of last year in its minutes. This is not. It doesn't even mean starting to raise rates immediately. It means starting to prepare the ground for raising rates. So exit is a very long and involved process. Monetary policies operate something that operates with long lags. I think we have to be careful not to let things get ahead of ourselves in the sense that we might well have to start to move as early as I indicated in 6 to 9 months.
And by move, I mean when you I think when you laid out the whole program of what the exit might look like, I think it was, since then it's the calendar date moving all the way out to 2014. I mean, would preparing the ground mean take that thing out of there? I mean, what form would it take?
Oh, I think that at that point you would be wanting to change the date to be reflective of your expectations when you would start to raise rates. And so, I certainly, if I'm talking about initiating exit in 6 to 9 months, that is not consistent with the language that's currently in the statement. I think that's.
So you would see a change to the language in that.
That would be a step I think one would take if the committee were to agree with my prognosis that we would be initiating exit in 6 to 9 months. You would wanting to be changing the language in the statement. I think even sooner than that time frame.
I realize you're not on the FOMC right now, but I wonder how much influence you think that you've had in, in terms of the way that committee is thinking about interest rates right now, especially in terms of what we saw recently with what their thinking is about the federal funds rate. I mean, do you think you have been having an influence at all?
You should talk to others about that. I mean, I think it's a great committee to be on. I've enjoyed my time on it immensely. I've learned a lot from other people. They've certainly influenced my thinking. I hope in my way that I'm able to influence them. So, how
would you characterize, what that committee is thinking right now about interest rates? I mean, do you think that there is some moving away from keeping?
The committee, I think you can see its thinking well described in the statement that was released at the end of the April meeting, and the chairman gave a press conference afterwards, and that I think that press conference is intended to convey the sense of the committee at that time. I think that's we speak for ourselves when we go out and give these remarks, and so I can only tell you about what I see.
Right, Alan. The need to reshape the Fed's balance sheet and get the $2 trillion off over the long term. How do you think about how that plays against sort of recovery, particularly in the housing market, which many people say is holding back overall economic recovery, in making that kind of balanced trade-off?
Yeah, I think that reducing our balance sheet in the long run, I think we do want to normalize the size of our balance sheet. But the growth in the economy will make that, we don't have to go back to where we were in 2007 because there's going to be growth in the economy and growth in the appropriate size of our balance sheet accordingly. I think it's something that's going to take place over a relatively long time frame. And the reason I say that is because we have the ability to tamp down inflationary pressures by using the interest on excess reserves as an instrument. So even though our balance sheet is large, and we keep it large, by changing the interest on excess reserves, we can calibrate the magnitude of inflationary pressures in the economy, just as we used to do by buying and selling assets. So there's no necessity that we have to get our balance sheet down to a more normal size before we get back to, in order to tamp down on inflationary pressures.
So do I hear you saying that the Fed views this as another quiver in the arrow that they're not really willing to take out of the quivers quickly?
You know, if you, again, I'll refer you to the exit strategy we described in June of 2011. Asset sales are described, you know, the reductions in the balance sheet are described, but that's something that's going to take place at some time, according to that exit strategy, at some point after the raising of rates. And the statement is, I think appropriately, the timing statement is vague about when that would take place, because it would depend on economic conditions and possibly the kind you're describing.
I want to quickly return, please, to what you called your theme of transparency. And it seems that, you know, the Federal Reserve Bank is an institution. You have the chairman who's holding press conferences, Fed presidents like yourself, who certainly are often interactive with the press. To what degree, you know, do you talk amongst each other about what kind of signals all those different voices are sending, and how significant of a shift do you look that this is?
Yeah, certainly it's you know, there was a distinction between transparency and clarity, and you know, at times being transparent doesn't always mean you're being clear. With that said, you know, I think the answer I just gave to Annie about not speaking for the committee is a really important one. That's the confusion that sometimes emerges. I think it's very appropriate for me to be sharing with the public my perspectives on monetary policy, and you know, with the idea that that's probably stuff I'm going to be sharing with my colleagues. I think that's very appropriate. It would be confusing and problematic if I started to speak for what is the committee going to be doing. And I try to be as clear, as possible, shall we say, on that dimension all the time, because that's where the confusion can come in. You know, as I indicated, you know, the committee can speak for itself. It's got the statement, it's got the minutes, it's got the chairman's press conferences. That's the committee speaking for itself. When I go out and talk, as I just did, or I'm talking to you now, I'm communicating about my perspectives. And you know, then there's the question that, you know, to what extent will those shape committee viewpoints down the road? Well, that's, you know, it's like any other committee. We'll see how that plays out.
One more.
You've said in past speeches a little bit more directly, you know, that monetary policy maybe can only do so much to bring the unemployment rate down at this point. Do you think that there are other levers that are sort of outside of your purview that could be pulled to help bring it down, or is this just this kind of intractable situation?
Well, I gave a speech in honor of the late Professor Hyman Minsky at Washington University in late March. And in that speech, I talked about the idea of offering subsidies. It was a very theoretical model, and one would have to explore this in a lot more detail than what I offered there. But I offered the possibility of offering subsidies to firms to hire workers, and that would be, you know, when you, a general principle in economics, if you subsidize an activity, more of it will take place. So that would be but you know, with that said, you know, if you subsidize something, it has to come out of somebody's pocket, and so you have to weigh those. That would be something you have to be weighed, and that wouldn't be my job. but that, you know, there are instruments available along those kinds, and you have to weigh the costs and benefits associated with them.